This week, we look at PEXA, Property Exchange Australia, which is likely to be the biggest IPO of 2021 with an expected market capitalisation of $3 billion. We asked Hugh Dive from Atlas Funds Management whether this is a good company. Good morning, Hugh.
Yeah, good morning, Chris.
Now, I'll set the scene for IPOs in Australia in June 2021 before we jump into PEXA. And we know that where we sit now, it's over the past months, investors have been faced with a barrage of glowing research from investment banks trumpeting the blue sky potential of several new companies seeking to be floated on the ASX.
Yep.
These are promising companies that come after two of the biggest and most hyped floats of 2020, being Nuix and Adore Beauty. They both saw their share prices hammered in 2021 after failing to achieve the revenue and profit targets that were touted into the prospectus. So in hindsight, the vendors of these two businesses timed their exits perfectly, capitalising on the COVID-19 themes of working and shopping from home. So with that ideal timing that we saw in 2020, the selling of companies, not buying the IPO, we're reminded that when analysing IPOs, few have been more eloquent on this subject than Benjamin Graham, the father of value investing, whose famous quote on IPOs is that our recommendation is that all investors should be wary of new issues, which usually mean simply that these should be subjected to careful examination and usually severe tests before they are purchased. There are two reasons for this double caveat. The first is that new issues have special salesmanship behind them, which calls, therefore, for a special degree of sales resistance. The second is that most new issues are sold under favourable market conditions, which means favourable for the sellers and consequently less favourable for the buyer. Critical point on that last one that we'll come back to. Now, that's the context we've set. Let's jump into PEXA. Hugh, where did this company PEXA come from?
All right. So, Chris, PEXA is the operator of a digital property settlements platform in Australia, and they currently process around about 80% of all property transactions. So this actually started in about 2008, where the state governments moved to transition property lodgement and settlement away from paper-based process, so handing over papers, to a more efficient digital settlements process. So PEXA was initially launched in New South Wales and Victoria, and it generates fees from managing transfers and mortgages and discharges all across Australia, Victoria, New South Wales, Queensland, South Australia and WA. So PEXA was previously owned by a consortium of the big four banks, Macquarie Group, Link Administration, plus the four state governments, as well as Paul Little. So, however, in 2019, a consortium of Link, Commonwealth Bank and Morgan Stanley Infrastructure bought out the governments, Paul Little and Macquarie Bank, and that deal sort of valued PEXA 2 years ago at 1.6 billion.
Okay, 1.6 billion. We're coming up to 3 billion is what we're looking at.
Yeah.
So good movement there in 2 years.
Yeah.
So it sounds like a tech company in the last 2 years then.
Yeah.
What kind of transaction would you call this? So we've got Paul Little, we've got the governments leaving and Macquarie. So is it PE to PE or what is it?
So a trade sale or PE to PE. And so, if PEXA can get the IPO at the stated valuation, Morgan Stanley will have doubled their money or doubled the valuation of PEXA in 2 years without major changes to the business. So that's the delights of private equity and alchemy, financial alchemy.
Right. Well, we're coming onto the boards to make it a public company. So let's have an understanding of what the business is. Is it something that can be readily understood?
Relatively readily understood, Chris. So it's PEXA's electronic conveyancing or e-conveyancing allows sort of conveyancers, so lawyers and financial institutions, to use their digital platform to prepare, sign and lodge legal documents, and that's needed for transfer of ownership to complete the sort of the financial settlement. So PEXA's exchange allows sort of direct transfer of funds on the same day, with the funds being sort of when you buy a property, the funds being dispersed to the vendor and then to their bank, where if they've got a mortgage, and paying out the existing mortgage. So PEXA operates in most of the 5 largest states, and all of which, other than Queensland, have mandated digital property settlements. So that's a pretty good business to be in. Good
business indeed. So does this mandate of digital property settlements now make PEXA kind of a monopoly or operate in like an oligopoly imposed by state legislation?
Yeah. So a sort of state-protected oligopoly with sort of 80% of sort of transactions.
Okay, so state-protected. Now, How does PEXA make money?
But we don't know for how long though, because the states no longer own a share in PEXA, so they're less incentivized to protect that oligopoly going forward.
Fair point. You did mention they sold out in 2019, so they no longer have a vested interest in protecting this environment. Okay.
Yeah.
And when we look at the company bringing the revenue in, how does it get to PEXA?
So PEXA's clients are about like 9,500 conveyancing firms and all the major financial institutions. So it represents the vast majority of mortgage lending in Australia. So PEXA doesn't charge upfront registration fees or subscription fees, but rather a fee per sort of successful PEXA transaction.
Yeah, you've got a really good image that we'll put on screen here. So we'll have it on screen as you're talking through these revenues.
Yeah, so but basically what we've got here is just the flows. So for every buy and sell of a property, PEXA will get about $117 from both the vendor and the buyer, and then a bit more if there's mortgages involved. So generally an extra sort of $100-ish if the mortgage is involved. Then so they'll get around about a bit over $100 for every when a mortgage is refinanced. And then for a few other fees, there is a range of other sort of other transactions where they get fees between sort of $15, $20 or $40. So it doesn't sound very much, but PEXA has around about 33 different classes of transaction charges. So generally sort of they get about $220 per settlement. So, and in 2021, PEXA expects to facilitate around about 3.3 million property transactions, and that represents around about 80% of all property transactions in Australia. And that is expected to generate revenue around about $280 million and a slight loss.
A loss there. So we've got 3.3 million property transactions.
Yeah.
We're going for a $3 billion valuation, and they generated $218 million revenue that led to a $4.6 million loss. Is that right?
Yeah, there is a reasonable amortization charge around that sort of $50 million. But sort of it hasn't been a very profitable business for a while. And it has a range of losses.
Looking at that revenue, how does that revenue get priced, and what are the restrictions there?
So PEXA's pricing, that they can't increase the price themselves. So they're set by the Australian Registrar's National Conveyancing Council, and that can only be increased at a maximum of CPI annually. So when I'm looking at this, limits PEXA's ability to grow profits by increasing pricing, and also reflects their sort of oligopoly to monopoly pricing. That's a limited lever for them to pull.
It's sounding a little bit like they're effectively a new age tech utility with regulated revenues, kind of like a gas pipeline or electricity provider or Poles and Wires. Is that fair connection, or no?
It's fair to say, and they're somewhat a regulated utility, but without the same levels of profitability that one would hope to get out of a regulated utility. For example, sort of Spark Infrastructure that owns all the poles and wires in Victoria and South Australia, and a chunk of the poles and wires is many magnitudes, hundreds of millions of dollars profitability. Similarly, something like Transurban, which is not quite a regulated utility, but close to it. Much more profitable. So this is sort of a tech regulated utility without the same levels of profits.
Okay, so a barely profitable or questionably profitable 3.3 million transactions, $3 billion valuation company in a regulated environment. Why is the vendor selling, Hugh?
Well, the motivation for an IPO is one of the first things we look at. So why is the vendor selling? So historically, investors tend to do well where the IPO is a spin-off from a large company, exiting a line of business. For example, sort of Wesfarmers selling down Coles, or whether the vendors are using the proceeds of the IPO to expand their business. I mean, the proceeds of this IPO are being used to allow Morgan Stanley Infrastructure to exit PEXA after 2 years, and normally this would be a huge red flag. There's some level of comfort in that existing shareholders, Lincoln CBA, remaining shareholders are increasing their exposure to it. But that's not. They're not using the money they're raising to dramatically improve or to grow the business. So it doesn't score well there.
So looking back through the register, Morgan Stanley with a recent addition in 2019, Link and
Yep.
CBA have been there from back when the governments started this with Paul Little. Is that right?
Yeah. But the Link and CBA did increase their holding, their percentage in 2019.
Okay.
And will be increasing their percentage holding in this IPO.
And is it fair? Not sure on the current status of CBA. Do they have an institutional or investment banking desk, or it's only Morgan Stanley who have that kind of functionality?
There's very little. It's not a major focus for the bank.
Okay, right. So more. Okay. Now, if we're looking at the profitability of the business, it's made a loss. How's the forecast looking in the prospectus? Is there sort of is there a great enticement or light at the end of the tunnel?
Well, sort of in 2021, PEXA is expected to generate 218 million in revenue and a small loss. And historically, PEXA has generated losses. Looking ahead in 2022, they are expecting to move to a slight profit, but it's not. Yeah, there's not a lot of profitability on this business.
Okay, so not shooting the lights out on profitability. No. How about financial stability?
Well, I mean, it's not great. So the initial gearing when the flow is going to be about 28%, and that's sort of due, though due to minimal profitability for PEXA, this represents an interest cover of 1 times because they're acquiring a $334 million debt facility, which is being used in conjunction with the IPO to pay Morgan Stanley out. So it doesn't score well on financial stability there.
Okay, so they're not only is the IPO raising money to pay out Morgan Stanley, they're also getting into debt to help Morgan Stanley exit. Yeah. Okay, it's an interesting proposition. We moved down to the crunch part of it. How attractive is the price in the IPO?
Not very. I mean, based on the offer, PEXA is going to be trading on a PE of FY22 PE of 155 times or a 31 times EBITDA. And then going through a lot of the research, the sponsoring brokers are likening PEXA to sort of blue sky technology players such as Xero, Afterpay, and Altium. Given PEXA's already dominance of the Australian market and limits on its pricing power, it's hard to see significant growth in its home market, which makes the sort of comparisons to some of these other tech companies quite difficult. And it's quite hard to make when you own. I think they're moving to a profit in 2022 based on increasing market share from 80 to 85%. So it's hard to make the case that PEXA has the same sort of growth trajectory of a very early stage Afterpay or Xero.
There's not a lot of blue sky left when you're at 80 or 85% by the end of the next fin year. 150 times multiples. Okay, so what's the upside? Are we expecting a sudden cost-cutting regime, leveraging an existing client base, maybe another rabbit to come out of the hat?
No. It's. I mean, these businesses are sort of what they are. I mean, the sole reason why, and looking through a lot of the documentation, why behind any investment in PEXA is the view that the company can expand into other sort of Torrens title jurisdictions, such as the UK or Canada. Torrens title is a method of matching the buyers and sellers of property. And while on the surface it seems attractive, PEXA's, if you look through PEXA's history, their dominance and sort of oligopoly or quasi-monopoly position originated from PEXA having the governments of Victoria, New South Wales, Queensland, and West Australia as shareholders. So PEXA's clearly benefited from having governments mandating e-conveyancing and effectively pushing consumers into using PEXA's service. And then obviously they sold their shares in 2019. Moving into new markets, of Canada and the UK, PEXA's not going to have this significant state-based advantage or government ownership advantage, and they'll be competing with rival payments and conveyancing platforms. And even in Australia, we know that the ASX are developing their own payments platform to compete with PEXA. So it's and also when you look at sort of this offshore expansion, they always much more expensive than you imagine and much more costly. And PEXA's are not likely to have that sort of governments forcing consumers in Canada or the UK to use their products. So,
looking like it's not looking like they can be an Afterpay or a Xero and suddenly expand overseas at exponential rates. It's
hard to make that case. They'll enjoy that extremely rapid growth and market share growth in a foreign jurisdiction where they have no advantages.
So is it fair to ask whether this is a mature e-utility incumbent holding a dominant market share in a regulated domestic environment that is being priced at the multiple of an e-commerce blue sky startup like Xero or Afterpay many years ago? Is that kind of?
Yeah, I think that's a very, very fair question. It's a very fair statement, and there's obviously also questions about how long PEXA can maintain their market dominance in Australia. I mean, one thing that's quite different with sort of software companies as opposed to other sort of monopoly utilities is what we know is that from like companies like the banks, fintech spend is not a one-off spend such as building transmission wires or a toll road. It tends to sort of require ongoing spend just to keep up with rivals at bay. Banks constantly write off capitalized IT spend on programs that become obsolete. So it's not, in terms of a sort of a dominant utility, it's a utility that's backed by sort of fintech and IT spend doesn't have the same characteristics as a toll road, where for example, Transurban spends that money building that toll road once and it lasts for 50 years. IT spend gets quite ongoing. So I think it's
so
a little bit different.
ASX could come up with their own competition, but Transurban
they're currently working on this.
Right, and we can't see a current another toll road being put next to the Cross City Tunnel at the moment. That's
very unlikely. Very unlikely.
Right. Well, thank you very much for the thorough insights on a heavily promoted IPO, and we're always grateful for your wise words, especially when valuing companies.
I think there's close to 10 brokers on this deal, so there'll be a lot of positive research out there. But
Well, the wise words are very much appreciated.
We won't be partaking in this project, everyone.
Right, well, neither will we. Thank you very much, Hugh Dive from Atlas Funds Management.
Thank you, Chris.